Hi, and in this video I'll talk about types of mortgage-backed securities. So mainly you've got mortgage-backed securities and asset-backed securities as separate or different types of securities. So asset-backed securities are securities backed by loans other than traditional residential mortgage loans or commercial mortgage loans. So whenever you have anything other than the mortgage, it's called asset-backed or ABS. So this could also be backed by receivables. Now, in terms of the mortgage-backed securities or MBS market, you've got two major categories. One is called residential MBS, and the other is called commercial MBS. So backed implies that the underlying serves as the collateral. If the quality and value of the collateral deteriorates, the value of the security also declines. So if you think about these securitized loans, it's like a derivative, right? Because its value derives from the underlying. The underlying in this case is a pool or a group of mortgage loans. So in residential MBS, pool of mortgage loans is used, or a lot of loans to individuals are pooled together. In commercial, you actually pool loans that are extended to businesses. Asset-backed securities and mortgage-backed securities are referred to as structured financial products, or SFP. Now, mortgage, I said before, but I think it's important to emphasize, mortgage is a loan secured by the collateral of some specified real estate property, which obliges the borrower to make a predetermined series of payments. So this is what a mortgage is. Residential MBS also is subdivided by type in terms of issuer. So MBS issued by federal agencies, considered usually high quality, and MBS issued by private entities. So what's the difference? Well, in the US, securities are guaranteed or in some way backed by federal government, are called federal MBS or federal agency backed MBS. These are considered higher quality because these government agencies or government sponsored enterprises stand behind these loans, okay? So it kind of gives credibility to these loans. They're higher rated for investors, by investors actually. Now, private MBS is not guaranteed by government, perceived as higher risk, higher credit risk, and it may be relatively illiquid because this is a smaller, basically, segment of the market. But credit can be enhanced by a variety of creative instruments, corporate guarantees, letter of credit, etc. In terms of residential MBS, in terms of the structure, there's traditional residential MBS, also called mortgage pass-through securities, and derivative residential MBS. These are more complex structured products or financially engineered products. They're called CDOs or CMOs, collateralized mortgage obligations or collateralized debt obligations. They're also stripped MBS by tranches in terms of the credit worthiness. Residential MBS also can be divided by sectors: prime market, subprime market. Prime basically means, highly creditworthy borrowers. Loans that satisfy the underwriting standard of Ginnie Mae, Fannie Mae, and Freddie Mac in the US. These are government-sponsored enterprises. They have specific standards for the quality of the credit quality of the loans. Now, subprime market for loans, it's provided to borrowers with an impaired credit rating or where the loan is a second lien. In other words, there is no first claim by the lender to this in case they default. Now, this is the market that started the 2008 financial crisis, if you remember. Now, when we look at the overall structure of this by types of MBS by design, in terms of structure and design, specification of interest rate, term, amortization behavior, etc., you can put it along these two basically axes. One is vertical credit risk, the higher the credit risk, and here the interest rate risk. So what happens is that you may have certain types of MBS which have very high interest rate risk but low credit risk. What does this mean? Interest rate risk is borne by the lender, right? And interest rate risk happens when you have actually extended a fixed rate loan and interest rates are going up. and which means the borrower is benefiting by paying much less than the market rate. So it's the interest rate risk which is higher, but the credit risk is very low, because in this kind of case, the payment on the mortgage constitutes probably a low or lower portion of the income of the mortgage borrower. So they actually relatively easily pay off their mortgage. So credit risk is less, interest rate is high. On the other hand, number 2 here, adjustable rate mortgage means, if interest rates go higher, the mortgage contract allows the lender to adjust the rate to make it higher, so that they actually don't lose on the interest rate side. So interest rate risk is relatively low, but credit risk is high. In other words, the borrower in this case may struggle to repay, because they probably didn't expect that rates would be much higher than they were paying before. So they didn't put aside money for that. So they may actually default. Their likelihood of default is much higher. And there's some in the middle, 5 and 6, for example, reverse mortgages and tiered payment mortgages. You may actually find out about this by Googling. Now, all of the principles we need to know regarding the risk associated with investing in mortgage-backed securities and the difficulties associated with their valuation can be understood just looking at this graph. In the next video, we'll analyze some mortgage-backed securities and we'll look at certain parameters or metrics that are used to measure prepayment risk and other things.